Okay, welcome everyone. I think I'll get started and underway. Happy New Year. I'm James Nelson. I am Principal and Head of Tri-State Investment Sales here at Avison Young. With us, we have Scott Singer, who's our Principal Co-Lead of Tri-State Debt and Equity Finance, then Brandon Polakoff, our Principal Executive Director of Tri-State Investment Sales. Thank you all so much for joining. We had a great meeting this morning with Nate Bliss, who is the Chief of Staff for the first Deputy Mayor here in New York City, and just excited to hear all the positive things that are happening within the city. Actually learned this morning that we now have a record number of jobs here in New York. We have a record number of businesses, and it's also the administration's prediction that this year we will have the most tourism traffic ever here in New York, which is a fantastic thing. We also had several conversations about City of Yes. We're going to be getting into that as well, but we're also very bullish about 2025, and so look forward to getting things underway. So I will go ahead and I'm going to share the deck, which again we will send to you all after the conclusion of this, and we'll dive right in. So first of all, you can see that there was a huge pickup in sales volume in New York City. Again, when we track, it's across all asset classes: multifamily, retail, office, development, conversions, over $5 million. That's our methodology across New York City, with the exception of retail, where we track $1.5 million and up. See a lot of the retail condos trading in that space. So for New York City, we had almost $16.5 billion. This was a 7% increase from the last quarter. We are still off the 10-year average, certainly of $31.8 billion, but a huge uptick from 2023. So if you remember one stat from this presentation, it is that there was a 70% increase in investment sales year over year in New York City. I will say that again. There was a 70% increase in dollar volume from 23 to 24 across all asset classes in New York City. It was even more pronounced in Manhattan. We're going to get to that shortly, but certainly we've turned a corner. Certainly there's positive momentum here, and it is really across the board on where you see this activity is coming from. So as we look at the number of sales, again, close to 550 sales on the year, off the 874 average, but you see increases in almost every single borough. So when you annualize and really look at this year over year change, again, you see what happened in New York City, less than 10 billion of sales in 2023. I mean, that was certainly a very challenging year. We hadn't seen dollar volume that slow since, I think, dating back to 2009. But you see that 70% uptick with almost $16.5 billion in sales. We see Manhattan sales up 86%. So you see how much Manhattan is driving the New York City sales volume with over $11 billion in sales. The number of transactions was less pronounced. So you have New York City at an 18% increase, and actually Manhattan actually had more uptick in sales year over year, 21%. But the fact that the dollar volume was so much more significant on the increase tells you that what was happening is larger, more significant sales taking place, many of those in Manhattan, many of those office. So when you look at where is the dollar volume coming from in Manhattan, office has made a huge step up, historically, and you look back to 2018, here, the office was well above 50% of the dollar volume. So this year, that is certainly the case, with office coming in with over half the transactions. In fact, the fourth quarter was very significant in that regard. So we're going to be reporting on some very significant asset class sales. So as far as number of sales, clearly it's still multifamily, where a lot of the multi mixed use, a lot more of that out there. So certainly by a number of sales, multifamily is still the largest portion of that distribution, but certainly healthy activity in retail. Look at the orange band, how much that's increasing in the number of transactions as a percentage of the whole, and development also widening. So let's talk about who's selling properties in the city. In Manhattan, we have, on one hand, you might say, okay, well, there's been a decline in foreign investment, excuse me, sellers, dropping from 38 to 11%. Who is filling the void? Institutions are now selling at a greater clip. So now you have institutions that are selling, accounting for almost 30% of the sales. REITs contributing another 11%, and then the private sellers at about 41%. When you look at the buyers in the market, and here also we saw a decline from foreign sellers, buyers rather, who were quick to jump in first in 2020. They were still strong buyers last year. Now we're seeing more of the domestic buyers, specifically the private buyers, really stepping up, with over 50% of the buyers being private here. And you are starting to see some increase in the institutional acquisitions. We're going to talk about a couple of those transactions shortly. REITs also accounting for 3% of the acquisitions, where in 2023 there were virtually no REIT acquisitions. So this is certainly positive in the sense that we have a lot more domestic activity, a lot more institutional activity. All right, so Brandon, why don't you talk about what we're seeing in the multifamily space? And you might be on.
Yeah, I was on mute. Sorry about that. Sure. So I think in terms of dollar volume and number of sales, quarter over quarter, it's down 10 and 3% respectively. That's a pretty small margin. So I don't think that's something too much to focus on. What was interesting, yeah, the average price per foot went up and the cap rate went up. Though I know we try to show us a range here. The reason being is not one size fits all. So it could be a fully rent regulated building. It could be a fully value add fair market building, and those are going to trade on drastic ends of the spectrum. Then there's also, user sales, which really can push up the dollar per foot for some of these, call it a 10-unit apartment building in the West Village that's vacant and that would be converted to a townhome. So that's where you could see like a $2,400 a foot range, or retail, very strong quarter, but still not predominant income. So overall, I would say more of the same. It's been pretty status quo in terms of what we're seeing in terms of pricing and dollar volume and sales. So yeah, that would be my general takeaway. It's been pretty status quo. So these were three of the top sales. So 540 Fulton Street, that was a 2023 construction. So that traded for $786 a foot. It was a 5.35 cap. That has a new 35-year abatement. 7030 building sold by to KKR from Janelle. 80 decab that was sold by KKR to Atlas. That was at $604 a foot, a 5.5 cap. That was 2011 construction. The abatement runs through 2036, and that was an 80/20 building. So again, those are two buildings, low to mid 5 caps with a lot of runway on the abatement. 165 East 66, that was sold to Stonehenge. That is a light value add building. They can do cosmetic renovations to push up the rents. Obviously, a great location. So that traded for, I want to say that was $686 a foot. That was a 4.5 cap with upside, and it was 22% rent stabilized. So again, I think what's interesting on that is, those were selling about 100 basis points lower when rates were lower. So originally looking to exit these deals were between, around a 4 cap. Now groups are trying to exit these closer to a 5 cap. So, or at least on the terminal value. So that's probably been the biggest change in the institutional space.
All right, thank you, Brandon. That was a great report on New York multifamily. The only negative feedback we're getting is why you continue to feature a picture of a Dallas Cowboy behind you. We've got a lot of Jets and Giants fans who are posting their thoughts in the chat. But okay, so let's talk about what's happening here in development. And interestingly, applications now are just opening up for 45X and 467M. And so these sales are still not necessarily with the benefit of these new incentive programs. It will not surprise you that a lot of these are for condo development. And it's good that I think we're now doing ranges as opposed just to averages. So if you said that the average piece of land's worth 660 a buildable, like multifamily, there was a huge range. We've got 380 a foot, in some cases up to 970 a foot. So it's a really big range, but we did have 6 sales that was about $304 million of value. Okay, so if we go to each of these sales, and I will say that they combined for about 2.5 million square feet of buildable, still off the 4 million average, but we'll see what happens once 45 kicks in. Certainly the number of units that are being produced are well below what the city's ambitious plan is. The moonshot plan was 500,000 new units. You could see that over the past few years, producing, in 23 only 12,000 units, 14,000 in 2024. We certainly do need the incentives and for the market conditions to improve to supply the type of units that we need to get to address this 1.4% vacancy. As far as the sales, we have 655 Madison Avenue for $159.4 million. Extel buys this from Williams Equity. This was a 100 by 109 foot site on the northeast corner of East 60th Street. And we'll see how Gary plans to potentially assemble some air rights. I think we have this pegged as a rental. I would be surprised if that ultimately was the case. Brandon, I don't know if that was confirmed. I would think with this kind of location and park views, I would think that this could definitely be a condo, but I guess we'll wait to see what's announced there. We also, interestingly, Extel was the buyer here at 655 Madison. They were the seller up here on 3rd Avenue. I think this is the old Pathmark site up on 125th Street. Here they sell to JCS Realty, planned for 543 rental units, and it will have a grocer on the ground floor. Last but not least, Continuum Companies buys 26-34 East 35th Street for $66.2 million for the Community Church of New York. And this site's got split zoning. Developer has plans for a 191-foot tall, 18-story mixed-use condo building with 137 rental units, as well as community facility. Okay, conversions have also been a big driver in the market here. So here at 77 Water Street, for $95.5 million. Van Barton buys from Sage Realty. Sage actually accounted for 2 of the conversion sales. Sage, and I actually just had Jonathan Iger on my podcast if you want to hear their plans, but obviously focused on office and not converting to residential. So they sold 77 Water for $95.5 million to Van Barton. This is a 170-foot high, 26-story building. There is over 500,000 square feet here. So plans are to convert this to 600 residential units. 767 3rd Avenue, $88 million. Quantum Pacific and Nathan Berman team up to buy again from Sage, 40-story building, 286,000 feet. And Brandon, if I'm not mistaken, Quantum Pacific, this is an Israeli group that's making their first acquisition here in New York, correct?
Yeah, they have family, but it's a all over. So relative to global holdings.
Wonderful. And then last, we have 143 Franklin at $35.6 million. This is over $1,000 a foot. Beautiful building. Would assume this is going to go condo with the CNY group. Now, I will say with the 467M, which we think is a really positive and helpful abatement where you're going to get a 30-year abatement where you're only paying 10% of the property taxes. Otherwise, I think we're going to certainly see a lot more of these office to residential conversions as a result. And we're going to come out with a full office study, but since COVID, we've tracked roughly 250 office sales, and only 11% of them so far have been converted to residential. Maybe I shouldn't say only. That still seems like a fair amount. It counts for about 7-8 million square feet. But I think we'll certainly see more of these with the new program. Okay, next we have retail, averaging now at close to a 6.5 cap. Again, look at that range between 3.6 and 9.6%. yield is moving up. The price per foot, again, it's a big range, as you can see, from 300 to 33 a foot to $5,400 a foot. So sometimes these averages might not be as instructive. But what's interesting is certainly, and we talked about the increase in institutional appetite. So here you have Blackstone making a splash, buying this portfolio in Soho from ASB and L3. This clocked in at a 3.6 cap, which is probably one of the tightest cap rates that we've seen in a while. And speaking to Blackstone, their belief is that they're going to get to a stabilized yield on cost of 6.5%. By raising rents considerably. So there is a value add proposition to this. Meanwhile, Empire State Realty Trust pays $52 million for retail in North Williamsburg from L3 Capital. ESRT not just making a splash beyond office in multifamily, but also in retail. And then here you have 300 and 303 West 42nd Street for $48 million. Brandon, this was a consortium of buyers, and it is a building, but again, the belief there is a lot of what's driving this is retail. Is that correct?
Yeah, that's correct. Once you back out the value of the retail, the upstairs is under $100 a foot for the vacant office space. It's entirely vacant upstairs. So really a retail driven play, and the office was kind of gravy.
Okay. So now we look at office sales, which again are a huge range. And for a while we stopped reporting cap rates because there were so few of them. But you can see the average price per foot, again, a huge range from 241 a foot to 1,400 is now down to 450 a foot on average. You see cap rates greatly expanding. But again, $1.5 billion of office trades doubling quarter over quarter. So that's why, again, when you look at 2024 coming to a year end and how significant these office trades were, very helpful in moving the needle, driving this. And a big trend we've experienced that 25% of office sales since COVID have sold to end users. So this was no exception at 2 Park Avenue. Haddad Brands buys this building from Morgan Stanley, which is pretty remarkable, at 850,000 square foot building. And you've got a clothing manufacturer that's going to be buying and using the building, that priced out at $419 a foot. Interesting, we're also seeing some office operator investors who might have seen some challenges in the past, and now they have regrouped and they're buying back in. And Savannah is certainly leading the way with some recent transactions. I believe there's another one in contract on 15th Street that'll be reported on in probably our next report. But here at 799 Broadway, they buy this for $255 million, $1,444 a foot from Columbia Trust, Cannon Hill. It's a remarkable building, corner of Broadway, 11th Street, 175,000 units. The sale closed at a high 4 cap, but was only 71% occupied at the time of sale. And, no surprise, rents, I believe, in this building have, in some cases, gone well into the triple digits. Last but not least, we have 180 to 202 Broome Street for $237 million. Here, Deutsche Bank buys from Taconic. This was an office condominium located on the north side of Broome between Suffolk and Clinton Street. The 2 properties have a total of 350,000 square feet. There's also 3 retail condominiums at the property that were conveyed in the sale. If you look at the historical pricing, you can see that definitely there has been some compression on a price per foot. Retail, again, kind of bouncing around. Office, obviously, taking the biggest hit. Previously north of 1,000 a foot in 2019. Now the average office is at 450 a foot. But as you can see, huge ranges going from sub $200 a foot in some cases in the financial district to, in some cases, north of 4,000 a foot on Madison Avenue. That was the Bloomberg Philanthropies acquisition last quarter at 980 Madison Avenue. And as far as cap rates, you can see some real expansion here in cap rates. Retail now averaging in the high 6% range, office eclipsing multifamily, pushing towards a 6% cap, and multifamily at a 5.7. But as Brandon mentioned before, there's a huge range based on, location, vintage of product, 421A regulation. But that is the average there. So we're certainly a lot to take in here, but very optimistic about the strong sales volume momentum. When you see that 70% uptick year over year for New York City, 86% for Manhattan, and we definitely see that as a signal that both buyers and sellers alike are getting off the sidelines. Scott's going to talk to us very shortly what's going on in the debt markets. But I think that also is a big part of, I think, again, buyers and sellers alike acknowledging kind of the new norm and participating in the market. We are also would like to point out that the return to office in New York City has been very strong. We're currently a top 3 city, second or third only to Miami and West Palm Beach. We think that a lot of that return to office at 78% compared to 2019 is also not just encouraging, because people are back in the office, but they're also renting apartments, they're shopping, also greatly helping retail. And then lastly, going to pay close attention to what City of Yes does. Close to 125 million square feet of office that'll now be eligible to convert to residential by virtue of taking the vintage, most of these buildings that had to be built before 68 to be eligible for conversion, bumping that up to 1991. Again, that's going to add about 125 million square feet eligible for conversion. Of course, not all of that will be, but it will certainly be helpful in that process. Okay, so with that, we will go to the state of the debt and equity markets. Scott.
Yeah, thanks, James. Hi, everybody. So I have a simple message this time. I think we can skip right through there. And it may be counterintuitive, but on the metrics that I look at, there are compelling reasons for anyone who is investing now or invested now with maturities coming to finance now. And obviously that's self-serving, but I think, James, it's the next slide really that matters and that I'm focused on, and that's the forward yield curve. And these upper lines are the treasury rates. The orange one is the 10-year treasury, and but both are projected by the traders who bet between short and long-term rates. All bets appear to be on the treasury going higher from here, and this is updated as of this is actually updated when treasuries were a bit lower. So this is a 4.5 10-year treasury, and we're at 480 today. So it is it appears that the index rates for fixed rate borrowers are going straight up by projection for the next 10 years. The black line is the SOFR rate, and the Fed is clearly appears to be focused on continuing to cut over time. This is not surprising, and it is in line with historical norms for the short-term rate. It used to be LIBOR, now it's SOFR, to be in the 200 to 250 basis point range lower than the treasuries. So for fixed rate borrowers, the index appears to be going higher, and for floating rate borrowers, the index appears to be going lower, which as a floating rate borrower, it is possible to take advantage of. The other aspect to pricing obviously is spreads. In both fixed and floating rate, or for both fixed and floating rate money, spreads are pretty good. They're not the all-time lows, but they're far closer to the all-time lows and the all-time highs, or even to the historical averages for most asset classes. We've seen liquidity come back in a small way, but that's meaningful, very meaningful, I think, in the office market, which has been the most challenged. And with the competition within the floating rate market, the impediment to riding SOFR down floors are now negotiable. So again, our read is that the borrowing rates waiting on borrowing rates to come down should not be an impediment now either for fixed or floating rate borrowers. James,
Thank you, Scott. Okay, so you can put your questions in the Q&A if you like, and I see we already have some of these, so why don't I start going down the list. Brandon, what is the explanation for the drop in foreign investment?
Drop in foreign investment. Well, I think upcoming foreign investment, one concern that's been raised over the last few weeks by foreign buyers that I'm speaking with is the strengthening of the US dollar and how that's impacting certain countries that have invested a lot in the United States over the last, or I guess New York City over the last few years. In particular, Japan and Korea. So that's going to be something to keep an eye on as we move forward. And if the US dollar continues to get stronger, it just makes it harder for them to continue paying the same prices.
Okay, yeah, and I would also add, and I think I mentioned, but also see it as a positive that, I mean, domestic buyers are stepping up. I think when there was kind of a vacuum and a lot of buyers were on the sidelines, a lot of the foreign investors who are largely cash buyers saw this as an opportunity to come into the market, take down some really high quality assets. But now you see a lot of the domestic private buyers, institutions that are getting back into the market. They can typically move a lot faster because they're here. And as they become more comfortable with, as Scott mentioned, financing, that'll also bring more buyers back into the fold.
Hey, James, I was
Yeah.
just going to add, I'm putting in the chat now a link to an article that was in the Wall Street Journal yesterday that I posted, and I've listened to it 4 times now, and it is a really interesting take on the various factors that cause rates, meaning the index rates, to rise and fall. So it's complicated territory. It's broken down very well in there, so I'd encourage everyone to grab that link.
Okay. Any major one or two takeaways from that, Scott? What would you say the top takeaways from that?
Well, I think that it's that combination of inflation, the causes of inflation and the effects of inflation are pushing both directions. And so it is a difficult balancing act for both the Fed and investors. But as the Treasury rates push towards 5%, that is something that tends to pull money out of the stock market into bond investments, and then the money flowing into bond investments has a further impact. And so we've said on most of the prior state of the markets, and we look backwards, and the current Treasury yields are roughly at the historical average. And so it's we certainly have we've had a surging stock market now. There's been some pullback, and yet we're still at extraordinarily high levels. But it's there's a lot to this. But when we're sitting at historical normals, without a lot of ability or impetus to push the rates back down, that's another place that I'm looking.
Wonderful. Now I know Todd wants to know about what your favorite fish show is of all time, Scott. I think maybe go back. You guys can speak offline and compare.
Obviously, we went to one we went to together.
Yeah, that's what I was going to say. But he's also asking us what investors are assuming for exit caps on office, multi, and retail. And I would just say that was very interesting. Again, that Blackstone on that retail acquisition, they're building to a 6.5%. So, do they believe that? I mean, Blackstone, they're pretty smart. Do they believe that retail cap rates are going to come within, to make that spread? I mean, that would have to get back into 5 territory unless they're really looking at that for its long-term growth. But Scott, maybe question for you. I mean, when banks are underwriting these deals to say lend on office, I mean, what are the exit caps that they are assuming in their underwriting?
Yeah, I've often been surprised at how relatively aggressive I think investors have been on the exit caps that they'll assume. And, often I've heard expectations of an increase of, say, a quarter point or less per year, even in rising rate environments. So from a lender's perspective, the focus is more typically on what the exit debt yield is likely to be. Because with regard to cap rate, lenders always have a significant cushion on value on the way in. And so this is a substantial challenge, and the liquidity within that's growing slowly in the office market is focused on certainly deals where there is long maturity dates on the leases.
Got it. Mike, we have a question about the foreign investment. If they're not, buying, why are they not selling? I mean, my observation, and Brandon, I don't know if you have a different view, but a lot of these foreign investors, once they come to New York, they tend to stay here. And if even they're going to buy, they're either buying for the long term or they're looking to, keep that money in New York. I think it's pretty rare than we see when
There's also major depreciation benefits in a lot of these countries. So, they hold them to offset gains in their home countries. And then
that's been a big driver for the Japanese acquisitions. I know we've talked about this on a previous webinar, but I think we've done over a dozen sales to Japanese buyers who are using accelerated depreciation for wood frame multifamily, which seems pretty specific, but it did lead to a lot of activity. But to your point, Brandon, once they're doing that, they are holding on to these assets to get the benefit.
Yeah. Also, there's a question here: with the large population of babies boomers reaching retirement, do you anticipate more near-term multifamily sales to occur in New York City? Generally speaking, with just like these long-time owners, most of them don't have much debt, if any. They have children too. What you often find is, unless the market's booming and they're saying, hey, we're going to get peak pricing, it makes sense to sell right now. I can tell you anecdotally, there's just not much strong value add product on the market coming from these long-term owners. And the reason it's usually driven in a down market, it's retirement. So the family is just saying, hey, we're done. There's a dispute or, a death. Unless those natural occurrences happen, most people aren't really motivated to sell their property. And so really, I think the best opportunities are going to come from those natural occurrences. And it's just a matter of how many there are in a given year. Sometimes it's a lot, sometimes it's a little. But yeah, when the market's where it is today, most people want to wait till we get back to, your 2014 to 2016 levels on pricing.
Mm-hmm.
Brandon, I had a question for you. Don't you think you'd be even more successful if you had a New York sports figure behind you?
Yeah, that's what I was saying before. Yeah, Scott, I know you've got some Jets helmets, although the resale value on those, unfortunately, seem to be. If we put that on our graph, it would be falling off the graph at this point.
At least no one can tell me I'm a front runner.
We have another question on construction materials and costs based on natural disasters, and again, we're send our thoughts out to our friends and certainly our offices in the LA area, and then with the East Coast hurricanes. I mean, Scott, how much is the insurance piece to this, or lack thereof, as you look to finance? And I know you're going to be working on a major assignment on the West Coast. Are lenders pretty cognizant of that? And if so, how are you approaching that?
They are. I mean, obviously, LA is unfolding now, and will make it dramatically worse. I think, for primarily a New York audience here, I would say, not wanting to, dance on tragedy, but I do think that there is an argument for the Northeast that the relative lack, knock on wood, of the types of natural disasters that are hurting other areas may be another compelling factor in pushing investment in the Northeast. We are, fortunate to have less storms and less earthquakes and more water and a moderate climate so far. So trying to focus on the good with regard to here, that is something that we think about with regard to investment inflows. The insurance premiums and the increases there are going to be the next in these challenges that come in underwriting from time to time. In 0102 it was terrorism insurance, and there have been other issues along the way, but it is going to be a challenge going forward.
Perfect. Scott, another one for you. CMBS appetite. What is that looking like these days? And I know part of your team's still down in Crefsey in Miami. I was there yesterday. Really great turnout and optimism there. But how much can we?
It's high. There's the liquidity, the overall liquidity in the debt market is as high as it's been probably at any time in my career. And the CMBS market has served over the last much of the last 18 months the original function where it was created. This incarnation of it created in the mid 90s when there was a vacuum of capital and that needed to be filled. And I think that in looking at the office loans that have been done through CMBS and the giant SASB loans that have been done that were likely only to be done by CMBS over that period of time, it was incredibly important to have the CMBS market as part of the industry. And I think going forward, it is not only a lender of last resort, but also very, very competitive and aggressive on most asset classes. So it's I'm glad they're here. And while there are challenges and certainly some borrowers are very aware of the negative side of CMBS borrowing, and in particular, I mean the necessity to deal with servicers who are often hard to reach or sometimes are acting across purposes. Having that supply of capital is just absolutely critical to the market.
All right, great. I think last one here, any updates on Midtown South rezoning? Oh, actually, sorry, we got some more questions coming in on the chat as well. Midtown South rezoning, the city told us that they're going to certify and begin the ULURP process, which should be about 7 months, but it looks like that's going full speed ahead as opposed to next week. That's going to be very helpful in conjunction with City of Yes to unlock a lot of these office buildings for conversion to residential. I think that is Anne-Marie who is asking, how long do you think the 2014-16 pricing might take for mixed-use multifamily? Brandon, and again, I know it's so dependent on, is it fair market? Is it rent regulated? But thinking to 2014, 2016, prior to HSTPA, certainly for regulated units that you used to be able to decontrol, certainly in a much lower interest rate environment. I mean, that being said, I mean, the rent growth is pretty spectacular here, barring that good cause eviction where, again, if you're built before 2009, you now cannot raise rents more effectively than, 9% with the CPI adjustment over 5%. But Brandon, do you think there's a world where multifamily pricing gets back to 2014, 2016 levels? I got to imagine rent growth would really have to be the driver to do that, right?
Yeah, I mean, there are so many variables. I think just go back 50 years and watch the peak and the trough, and New York City goes like this. So, will it get there? If you believe in New York City, and yeah, it'll get there. If you believe in market cycles, it'll get there. When it gets there and how, I think there's just so many variables that it's really tough to determine. But I think, yeah, if you have patient capital and you're not looking at an IRR and you're just saying, hey, is the market going to go back up from here? If I was a betting man, which I'm not, I would say yes. I just don't know when and how, and I think trying to make that prediction would be really tough right now.
Yeah, I mean, as we're looking at these development sites for rental in Manhattan, you know, and across the city, across Manhattan rather, I don't think we've seen one project where the projections are less than $100 a foot rent. So, you know, what does that mean for, you know, pre-war, you know, fair market that's renting at $50, $60 a foot? If new construction is north of 100, I mean, there seems to be a pretty, in some cases, a gap there. Now, obviously, you know, some of the smaller, efficient East Village walk-ups, Brandon, I'm sure you've seen north of $100 a foot there as well. But there is plenty of growth opportunity there as well. So, well, great. Well, we really appreciate you all joining in. Our theme for this year is Thrive in 2025. So we're really looking forward to working with you all, and great things ahead. Have a wonderful day. Thank you again.